This is the story of Warburg Pincus, one of America's most influential yet understated private equity firms. For nearly 6 decades, this company has shaped modern finance through patient capital, strategic vision, and institutional discipline. Today they manage nearly $100 billion, but their journey began in very different circumstances during one of history's darkest periods. Our story begins in 1939 when Erich M. Warburg arrived in New York City as a refugee from Nazi Germany. Born in 1900 into one of Europe's most distinguished banking families, he carried a name that meant something. The Warburgs had been merchant bankers since the 16th century, and his uncle Paul had helped design the Federal Reserve System. But by 1938, Nazi persecution made Germany uninhabitable for Jews despite the Warburgs' prominence. The family's bank, founded in 1798, was being stolen by the Nazi regime. Erich was 39 years old when he opened a small office at 52 William Street in New York. He named it E.M. Warburg & Company. He had connections, a famous name, some capital, and desperate determination. What he didn't have was a clear business model. In September 1939, Germany invaded Poland and World War II began. America's economy was still recovering from the Great Depression, with unemployment near 17%. The stock market hadn't recovered its 1929 peak. Capital was scarce and trust even scarcer. E.M. Warburg & Company started as a private investment counseling firm where Erich provided advice to wealthy families and managed some money. The firm was tiny, with perhaps 20 employees through the 1940s and 50s. They survived but didn't thrive. Erich knew European-style merchant banking, taking positions in companies and providing patient capital, but he lacked the scale and American relationships to do this effectively. E.M. Warburg remained a respected but minor player. By the early 1960s, Erich was in his mid-60s and facing reality. He wanted to return to Germany and help rebuild the family bank. His New York firm needed new leadership if it was going to have a future. That's when Lionel Pincus entered the story. Born in 1931 to a Jewish family in Philadelphia, Lionel Irving Pincus was everything Erich Warburg wasn't. His grandparents were immigrants from Russia and Poland. The family owned retail businesses and some real estate, but weren't wealthy by New York standards. Lionel was smart, ambitious, and hungry. After graduating from the University of Pennsylvania in 1953, he got his MBA from Columbia Business School. He joined a small investment bank while still in school, and by age 29 had made partner, an extraordinary achievement. In 1964, Pincus formed his own financial consultancy. He was thinking about what would become private equity, taking positions in companies and helping build businesses over time. He joined E.M. Warburg's board in 1965. The chemistry was fascinating. Erich was old European banking aristocracy, cultured and cautious. Lionel was young American hustle, energetic and aggressive. In 1966 they merged their firms, creating what would become E.M. Warburg Pincus & Company. Erich retired to Germany soon after handing control to Pincus. The office language switched from German to English, and the culture shifted from European restraint to American entrepreneurialism. There was drama in that name though. Erich's cousin Siemund Warburg, who had built a powerhouse bank in London, was furious. He accused Erich of prostituting the Warburg name by selling it to Pincus. The class tensions were real between established German Jewish banking families and newer Eastern European Jewish immigrants. But Lionel Pincus had the last laugh. What Pincus understood in 1966 was that American capitalism was entering a new phase. The post-war boom was maturing. New technologies in semiconductors, computing, and telecommunications were emerging. Service industries were professionalizing and healthcare was modernizing. In all these sectors were companies too large for traditional venture capital but too small for investment banks. They needed growth capital to scale rapidly. This was the opportunity Pincus identified, not venture capital for early-stage startups and not leverage buyouts, which didn't really exist yet, but growth equity, providing meaningful capital to established companies with real revenues and proven management teams. In 1967, Pincus recruited John Fogelstein from Lazard Frères to help build the firm. Together they developed their approach. They would invest across sectors and stages, be actively involved taking board seats and helping with strategy, and be patient holding investments for years rather than flipping quickly. The first formal private equity fund came in 1971, Warburg Pincus Capital Company with $41 million. They called the entire amount on day one, requiring every investor to wire their full commitment immediately. This seems bizarre today when firms call capital only as needed, but in those days nobody trusted their investors. The industry was so new that managers worried investors might not honor commitments when called. Through the 1970s they made investments across industries. They backed 20th Century Fox, providing capital during a difficult period for Hollywood. They invested in Humana, helping the healthcare company expand. These weren't technology moonshots but real businesses that needed capital to scale. Pincus also did something transformative for the entire industry. In 1978 he led discussions with the Labor Department to change regulations restricting pension fund investments. At the time, pension funds controlling hundreds of billions of dollars were largely prohibited from investing in private equity. Pincus argued they could improve returns by allocating some assets to private equity, and he helped draft regulatory changes allowing this. The impact was enormous. Once pension funds could invest, the amount of capital available exploded. What had been a cottage industry grew into a multi-hundred billion dollar asset class. Why did Pincus spend time on policy? Because he understood the constraint wasn't deal flow or talent, it was capital. By expanding the investor pool he ensured long-term growth. The 1970s were challenging for most investors. Stagflation, high inflation combined with stagnant growth, made it terrible for traditional portfolios. The stock market went nowhere from 1966 to 1982. But for Warburg Pincus this environment created opportunities. One early success came with Humana in the mid-70s. The hospital management company was consolidating small hospitals and building a national network. Warburg provided growth capital and advice as Humana expanded. The investment worked because healthcare demand was inelastic and people needed medical care despite economic conditions. When they exited in the early 80s, they'd generated returns of approximately 15 times their investment. Another significant investment came in entertainment. In 1973, Warburg provided capital to 20th Century Fox during a difficult period for Hollywood. The investment required patience, but Fox's library of classic films would generate television and home video revenues for decades. These early investments established patterns that would characterize Warburg Pincus for decades. They focused on established businesses with real revenues rather than early-stage ventures. They looked for companies in growing industries experiencing temporary problems. They took board seats but didn't try to run the businesses. They held investments for years, riding through volatility to capture long-term value. By 1982, when aggressive interest rate policy finally broke inflation and the Great Bull Market began, Warburg Pincus had built a solid track record. They'd established an identity as patient growth-oriented investors who partnered with management rather than financial engineers looking for quick flips. The mid-80s transformed private equity from cottage industry to headline-dominating force. From 1982 to 1989, over 2,000 leveraged buyouts totaling more than $250 billion were completed. The architect was Michael Milken at Drexel Burnham Lambert, whose innovation made billion-dollar acquisitions possible through junk bonds. The 1982 Gibson Greetings buyout exemplified the possibilities. Investors acquired the greeting card company for $80 million, contributing just $1 million in equity. 16 months later, they completed a $290 million IPO. One investor personally made $66 million, a 6,600% return in less than 2 years. Warburg Pincus participated in this boom, but with restraint. While firms like KKR did massive highly levered deals, Warburg focused on growth equity with less leverage. This looked conservative in the mid to late 80s when others generated eye-popping returns. Some questioned whether they were too cautious. Then the music stopped. In 1989, the junk bond market collapsed. Drexel Burnham Lambert filed for bankruptcy in February 1990 and dozens of highly leveraged deals collapsed. Warburg Pincus emerged relatively unscathed. They hadn't done the mega deals now collapsing, and their conservative approach during boom years now looked prescient. The 1990s brought transformative change. The internet emerged to become the dominant economic force. Globalization accelerated as barriers fell and capital flowed across borders. The Soviet Union collapsed, opening Eastern Europe. China's economy began explosive modernization, and India started liberalizing after decades of socialism. For Warburg Pincus, this was their golden era. They'd spent the 80s building capabilities while avoiding excesses that destroyed competitors. In 1988 they hired William Janeway as head of high technology investing. He was unusual for private equity, a PhD economist who brought both theoretical sophistication and practical deal-making skills. Janeway led Warburg to focus intensively on enterprise software after 1991. The business model was compelling. Sell perpetual licenses to enterprises with annual maintenance fees typically at 20% of license cost. This created highly predictable recurring revenue once a customer base was established. Sales cycles were long and expensive, but once software became embedded in workflows, switching costs were enormous. Market leaders could generate 70 to 80% gross margins and 30 to 40% operating margins at scale. In 1992 they funded OpenVision Technologies, which built tools for managing Unix systems. Warburg invested approximately $25 million to help OpenVision scale. As the internet boom accelerated and enterprises built web infrastructure, demand for storage management software soared. By the time Warburg distributed their shares in the late 90s, that initial $25 million investment had generated approximately $750 million in proceeds, a 30 times return representing roughly 43% annual returns. But this would be overshadowed by an even more spectacular success, BAE Systems. In 1995, 3 experienced software executives founded BAE Systems with a clear vision. They'd all worked at Sun Microsystems and understood that applications needed middleware to communicate reliably across networks. Most venture capitalists were more excited about consumer internet companies than enterprise middleware. Warburg saw it differently. Bill Janeway and his team recognized the pattern from previous successes. In 1995, Warburg invested approximately $54 million as the sole institutional investor. BAE Systems went public in 1996 at approximately $250 million valuation. Over the next 4 years, as the internet boom accelerated, BAE rode an extraordinary wave. Enterprises rushed to build e-commerce websites and online services, and all needed middleware. By late 1999, at the bubble peak, BAE's market cap exceeded $30 billion. The stock had appreciated more than 100-fold from the IPO price, and Warburg's stake was now worth approximately $7 billion on their $54 million investment. In practice, Warburg distributed their BAE shares to limited partners gradually over 1999 to 2001. By the time distributions were complete, they'd realized approximately $6.5 billion in total value on their $54 million investment. That's a 120 times return, or approximately 68% annual compound returns over roughly 6 years. It remains one of the most successful venture capital investments in history. Between these software companies alone, Warburg generated over $7 billion in proceeds from approximately 75 to 80 million invested. But while the technology team generated these extraordinary returns, another part of Warburg was pioneering an even more transformative strategy, emerging market investing, particularly in Asia. In 1994, Warburg opened its first Asian office in Hong Kong, making them one of the first major U.S. private equity firms to establish meaningful presence in Asia. Charles K. moved to Hong Kong to build the Asian operation. In 1996, Warburg began investing in India, opening a Mumbai office in 2001. This was remarkably early, when most global firms wouldn't enter India seriously until the mid-2000s. This is where Sunil Bharti Mittal entered the story. In the mid-90s, he was building cellular networks under the Bharti brand, competing in India's chaotic nascent mobile market. In 1999, when Warburg's team met Mittal, they saw an exceptional entrepreneur building what could become India's leading mobile operator. Between September 1999 and July 2001, Warburg invested $292 million in Bharti Televentures for approximately 19% ownership. At the time of first investment, Bharti had roughly 104,000 mobile subscribers, insignificant in a country of 1 billion people. Warburg didn't just provide capital. Team members joined Bharti's board and worked closely with Mittal on strategy. They helped structure acquisitions of additional telecom licenses, provided guidance on international best practices, and facilitated relationships with equipment vendors and lenders. The journey from 1999 to 2005 tested everyone's conviction. But Bharti executed brilliantly. By 2005, Bharti had 20 million subscribers and was valued at over $15 billion, a 150-fold increase from when Warburg first invested. Warburg chose a staged exit over 2004 to 2005. In August 2004, they sold 3.35% of their stake for $208 million. In March 2005, they sold another 6% for $560 million. Finally, in October 2005, they sold their remaining stake to Vodafone for $847 million. Total proceeds were $1.62 billion on $292 million invested, a 5.5 times return in 6 years, representing approximately 33% annual compound returns. Beyond the financial returns, Bharti established Warburg as the premier private equity investor in India. When high-quality Indian entrepreneurs needed growth capital, they thought of Warburg first. This playbook would be replicated dozens of times across China, Brazil, and other emerging markets over the next 2 decades. The late 90s technology bubble tested Warburg's discipline. From 98 to early 2000, internet mania gripped Silicon Valley and Wall Street. Warburg made some internet investments but remained selective. When the crash came in 2000 to 2002, the carnage was severe. Warburg emerged relatively unscathed. By 2003, the global economy was recovering. The Federal Reserve had cut interest rates dramatically, with the Fed funds rate falling to 1% by mid-2003. These low rates flooded the financial system with cheap money, launching the greatest buyout boom in history. From 2003 to 2007, private equity firms completed over $3 trillion in leveraged buyout transactions globally. Warburg participated in this boom, but once again with restraint. But they did do one deal that would define this era and test the limits of their model: Bausch and Lomb. In early 2007, Warburg began evaluating Bausch and Lomb, a 154-year-old company. The company manufactured contact lenses, lens care solutions, ophthalmic surgical products, and prescription drugs for eye conditions. It had global distribution, a strong brand, and operated in an attractive sector. In October 2007, after months of research and negotiation, Warburg agreed to acquire Bausch and Lomb for $8.7 billion, including debt. Warburg would contribute $3.67 billion in equity, the largest equity check the firm had written. The remaining $5 billion would come from debt financing. But the timing was terrible. The deal closed in October 2007, just as credit markets were beginning to seize up. Within weeks, the global financial crisis would accelerate. By March 2008, Bear Stearns collapsed. Lehman Brothers would fail in September, and the entire global financial system came close to collapse. Bausch and Lomb's operating performance actually held up reasonably well, but the financial structure became untenable. The debt burden, which had seemed manageable in a normal credit environment, became crushing when credit markets seized. Warburg had to choose: inject more equity to avoid default, or let the company restructure through bankruptcy. They chose to support the company. Over 2008 to 2010, they worked around the clock with lenders to amend covenants, extend maturities, and restructure debt. By 2011, the crisis had passed. In 2012, the company was strong enough to pay Warburg an $800 million special dividend. In 2013, Valeant Pharmaceuticals offered to acquire Bausch and Lomb for $8.7 billion, the same enterprise value as Warburg's original purchase price. The headlines announced they'd tripled their money, investing $3.67 billion and receiving approximately $7 billion back. That's roughly a 3 times return, generating about 20% annual returns over 6 years. But look closer, and the reality was more complex. The enterprise value hadn't changed meaningfully, $8.7 billion in and $8.7 billion out. Warburg's impressive returns came primarily from financial engineering. The actual value created operationally was modest, and the risk-adjusted returns looked less impressive when you consider they had come close to losing their entire investment during the crisis. The Bausch and Lomb experience revealed the limits of Warburg's approach. Their genuine capabilities, healthcare expertise, operational support, patient capital, all mattered and helped preserve value through the crisis. But these capabilities couldn't overcome the fundamental mistake of doing a highly leveraged deal at peak valuations at the worst possible moment in the credit cycle. The experience taught expensive lessons. First, timing matters more than investors want to admit. Second, healthcare isn't as defensive as it seems when you load it with debt. Third, the availability of cheap debt doesn't mean you should use the maximum. Fourth, covenant-light debt that seems investor-friendly in good times leaves you with no flexibility in bad times. While Bausch and Lomb consumed significant attention, it was only one investment in a large portfolio. Several factors helped them weather the storm. Their diversification across sectors, stages, and geographies meant they weren't concentrated in the most cyclical or over-leveraged segments. Their long-term relationships with limited partners meant they didn't face the liquidity pressures that forced other firms to sell assets at distressed prices. Their relatively conservative leverage practices on most deals, Bausch and Lomb was an exception, meant fewer portfolio companies faced imminent default. The 2010s brought a changed landscape. The financial crisis had eliminated or weakened many competitors. At the same time, massive monetary stimulus from central banks created an extraordinary environment for financial assets. Warburg emerged from the crisis with several advantages. Their reputation as a supportive patient investor had been enhanced by their behavior during the crisis. Their global platform, especially in Asia, positioned them to capture growth. In 2012, they raised a $12 billion fund, the largest in their history at that point. By 2022, they would raise $17 billion. The firm had grown from a small New York partnership to a global institution managing nearly $100 billion across multiple funds and strategies. But with scale came challenges. How do you deploy $15 to $20 billion funds while maintaining investment discipline? How do you preserve culture and decision-making quality as headcount grows? Warburg adapted in several ways. They doubled down on their international presence, particularly in Asia. They expanded into new sectors while maintaining concentrated expertise. They developed more sophisticated value creation capabilities. They maintained discipline about investment pace and valuations. Several investments from the 2010s demonstrated both their continued capabilities and the challenges of generating exceptional returns in a mature competitive market. In 2011, Warburg acquired Neustar, a provider of real-time information services, for $2.5 billion. Over 6 years they helped Neustar expand, and in 2017 sold to Golden Gate Capital for $3.5 billion, generating approximately a 2x return. Not spectacular but solid. In 2012, Warburg made an early-stage investment in CrowdStrike, a cybersecurity company pioneering cloud-native endpoint protection. CrowdStrike went public in June 2019 at approximately $6.8 billion valuation. By late 2024, the company's market cap exceeded $80 billion. Warburg's total investment across multiple rounds was approximately $250 to $300 million, and their total value realized was estimated at $2.5 to $3 billion, roughly a 10x return. While not approaching the 120 times return from BAE Systems, it demonstrated that Warburg could still identify and support enterprise infrastructure companies that became category leaders. In 2002, Lionel Pincus retired as managing partner after 36 years of leadership. The firm transitioned leadership to Charles Kay and Joseph Landy, both of whom had been with Warburg since the 80s. This succession was remarkably smooth. Both men had been groomed for decades and were committed to institutional continuity rather than radical change. They oversaw expansion from roughly $15 billion in assets under management in 2002 to nearly $100 billion by 2025. In 2022, Jeff Pearlman became the firm's CEO and managing partner, representing the third generation of leadership. When COVID-19 struck in early 2020, Warburg immediately moved to triage mode. Their diversified portfolio helped as some sectors crashed while others boomed. The aggregate portfolio impact was manageable because gains in some areas offset losses in others. The unprecedented monetary and fiscal stimulus quickly stabilized financial markets. By end of 2020, markets had reached new highs. For private equity generally and Warburg specifically, the 2020 to 2021 period became extraordinarily profitable. By 2024 to 2025, Warburg faced the challenges common to all large, successful private equity firms. They had approximately $97 billion in assets under management, employing over 200 investment professionals across offices worldwide. They were competing for deals with dozens of other well-capitalized private equity firms that had similar resources and capabilities. In this environment, the sources of competitive advantage that powered their earlier success were harder to sustain. The fundamental challenge was mathematical. Generating strong returns on $15 to $20 billion funds was much harder than generating strong returns on $1 to $5 billion funds. Warburg's approach involved maintaining discipline on investment pace and valuations, even if it meant deploying capital more slowly than competitors, leveraging global scale to pursue international opportunities where competition remained less intense, focusing on sectors where they had genuine expertise advantages, and maintaining institutional quality and culture. After nearly 60 years, certain principles emerge as foundational to Warburg's approach. Principle 1: growth creates more value than cost cutting. Warburg consistently prioritized revenue growth and market expansion over aggressive cost reduction. Principle 2: time horizon is a competitive advantage. Patient capital holding investments for 6 to 10 years or longer created multiple advantages. Principle 3: specialization beats generalization. Deep sector expertise accumulated over decades created competitive advantages in evaluating opportunities and generating returns. Principle 4: relationships generate proprietary opportunities. The best deals came from relationships rather than auctions. Principle 5: emerging markets offer structural advantages. Investing early in emerging markets before they became efficient and competitive created enormous opportunities. Principle 6: value creation requires operational involvement. Providing capital alone wasn't enough, and successful investing required working closely with management on strategy and execution. Principle 7: discipline matters more in bull markets. The greatest risk wasn't losing money in bear markets but overpaying and overleveraging in bull markets. Principle 8: cultural continuity enables compounding. Sustained success required institutional culture that could survive leadership transitions and market cycles. What can today's investors learn from Warburg's 60-year history? Time horizon is more important than intelligence. Warburg wasn't necessarily smarter than competitors, but they had patience. Specialization compounds over time. The best opportunities are often unpopular early. Market timing beats stock picking. Leverage amplifies both gains and losses. Culture matters more at scale. Emerging markets require patient local expertise. Excellence in execution matters more than brilliant strategy. Know what game you're playing. The biggest risks come from success, not failure. The Warburg story reveals that sustained success in investing comes less from individual genius than from institutional capabilities built over decades. Success required the right people making the right decisions at the right time, a combination of skill and luck that's impossible to fully disentangle. The story also reveals the powerful role that debt plays in private equity returns. Much of the industry's excess returns come not from operational value creation but from leverage. This works until it doesn't, as the 2008 to 2009 financial crisis exposed. Perhaps the most poignant lesson is how success creates its own challenges. The small, nimble firm of the 70s and 80s could move quickly and generate exceptional returns on $500 million funds. The massive institution of the 2020s managing $97 billion faces mathematical constraints that prevent repeating that performance at scale. Over nearly 60 years, Warburg invested in over 1,000 companies across 40 countries. These companies collectively employed millions of people, generated hundreds of billions in revenues, and created enormous economic value. The Warburg story is ultimately one of adaptation and persistence across 6 decades of profound change. From a refugee's modest firm to a global institution managing nearly 100 billion, the firm survived and thrived by consistently adapting to changing conditions while maintaining core principles. Through all this adaptation, they maintained certain constants: long-term thinking, sector specialization, operational involvement, patient capital, cultural continuity, and institutional quality. Their story teaches that sustained excellence in any complex endeavor requires both principled consistency and pragmatic flexibility. You need core values and approaches that remain constant across cycles, providing identity and direction, but you also need willingness to adapt strategies and tactics to changing conditions. Finding the right balance between what to hold constant and what to change determines long-term success. The ultimate lesson may be this: in investing as in life, there are no permanent solutions, only intelligent adaptations to continuously changing conditions, guided by enduring principles and tempered by hard-won wisdom. The Bausch and Lomb story didn't end when Warburg sold to Valeant in 2013, and what happened afterward reveals much about the private equity industry's complicated legacy. Valeant Pharmaceuticals, led by CEO Michael Pearson and backed by activist investor Bill Ackman, pursued an aggressive strategy of acquiring pharmaceutical and healthcare companies, slashing research and development spending, and dramatically raising prices on established drugs. When Valeant acquired Bausch and Lomb for $8.7 billion, they immediately implemented this playbook, cutting research and development, raising prices aggressively on contact lenses and ophthalmic solutions, and pursuing additional acquisitions funded with more debt. For a few years the strategy appeared successful as Valeant's stock price soared and Wall Street applauded their efficient capital allocation model that avoided wasteful research spending. But by 2015 to 2016 the model collapsed. Valeant faced congressional scrutiny over price gouging, and their accounting practices came under investigation. The debt burden became untenable and the stock crashed from over $260 in 2015 to under $10 by 2017. In 2018, Valeant changed its name to Bausch Health Companies to distance itself from the scandal. This epilogue raises uncomfortable questions. Warburg sold Bausch and Lomb to a buyer whose subsequent behavior was widely criticized and ultimately destructive. Did Warburg have any responsibility for what happened after they sold, or is their obligation limited to maximizing returns for their limited partners regardless of what happens next? The industry's consensus answer is that Warburg did nothing wrong. They sold to the highest bidder, which is their fiduciary duty to limited partners. What Valeant did afterward was Valeant's responsibility, not Warburg's. This is legally correct and within the industry's ethical framework defensible, but it leaves a nagging discomfort. Warburg owned Bausch and Lomb for 6 years and made decisions about capital allocation, management, strategy, and debt structure that positioned the company in a particular way. They chose to sell to Valeant knowing or having the ability to know Valeant's business model and philosophy. They received $4.5 billion from a transaction that required Valeant to take on additional debt, raise prices, and cut costs to justify the purchase price. The answer to whether Warburg bears any responsibility is complex and probably comes down to individual moral intuitions about responsibility and causation. What's clear is that private equity's impact extends beyond the direct relationship between firms and their portfolio companies. The companies they build, the capital structures they leave behind, and the buyers they sell to all have downstream consequences. Warburg, to their credit, generally operated more responsibly than many competitors, but even responsible private equity firms participate in and benefit from an industry whose broader effects on wealth distribution, employment, stakeholder welfare, and social trust remain contested and consequential. Beyond their portfolio investments, Warburg's most significant creation was the institution itself. From a small private investment counseling firm in 1939 to a global private equity powerhouse managing nearly $100 billion by 2025, the firm's own evolution is a remarkable story of institutional building. The firm's culture rested on several pillars established early and reinforced consistently. First, long-term thinking was genuinely embedded, not just rhetoric but reflected in fund structures, compensation, and decision-making. Partners' wealth was heavily invested in Warburg funds, aligning personal interests with limited partner returns over 10 to 15-year horizons. Second, intellectual honesty and rigorous analysis drove decision-making. The firm developed sophisticated frameworks for evaluating opportunities refined over decades through experience. They conducted exhaustive research, often spending 6 months or more studying potential investments. They documented lessons learned from both successes and failures, creating institutional memory through written investment memos, postmortems, and knowledge-sharing processes. This systematic approach reduced reliance on individual genius and created more consistent results. Third, meritocracy and talent development built organizational depth. Warburg hired smart people early in careers and developed them through apprenticeship and increasing responsibility. They promoted from within based on performance rather than politics, creating loyalty, ensuring cultural continuity, and building bench strength so the firm didn't depend on a few superstars. Fourth, collaboration rather than internal competition created synergy across the firm. Economic incentives were structured to reward firm-wide success rather than individual deal-making. Partners shared information and expertise freely across sectors and geographies. Fifth, low-ego professionalism maintained focus on substance over style. Leadership avoided media attention and personal celebrity. They didn't make bold public predictions or engage in controversial activities that could create distractions. They focused on the work, finding opportunities, conducting research, supporting portfolio companies, delivering returns, rather than building personal brands. These cultural characteristics were interconnected and mutually reinforcing. Long-term thinking supported intellectual honesty because you could admit mistakes that wouldn't be judged solely on short-term impact. Meritocracy supported collaboration because talented people secure in their careers were less defensive and territorial. The result was an institution that could survive leadership transitions, market cycles, and strategic evolution while maintaining core identity and capabilities. When Lionel Pincus retired in 2002, the firm didn't collapse or change fundamentally because the culture and systems transcended any individual. When the financial crisis struck in 2008, the firm navigated it successfully because institutional capabilities were embedded systematically. When markets became more competitive in the 2010s, the firm adapted by expanding geographically and building new capabilities while maintaining discipline. The social and economic impact of Warburg's investments extended far beyond returns to limited partners. Bharti Airtel exemplifies transformative value creation. When Warburg invested $292 million in 1999 to 2001, Bharti had 104,000 subscribers and was losing money. By 2025, Bharti Airtel had grown into one of the world's largest mobile operators with over 550 million subscribers across India, Africa, and South Asia. The company employed over 30,000 people directly and hundreds of thousands indirectly through its distribution network, generating over $20 billion in annual revenue. It had invested tens of billions in telecommunications infrastructure that connected hundreds of millions of people to the digital economy for the first time. Warburg's capital and support during the critical period enabled this growth. They provided $292 million when few others would invest in Indian telecommunications. They offered strategic guidance on technology choices and expansion strategies. They facilitated additional capital raises from other investors and stayed patient through regulatory crises and competitive battles. While Sunil Bharti Mittal and his team deserve primary credit for building the business, Warburg played a meaningful supporting role, and the social impact of connecting hundreds of millions to communications and the internet was profound. BA Systems represented technology infrastructure that enabled the internet economy. Warburg's $54 million investment in 1995 helped BA build application server software that became foundational to enterprise computing. The value created extended far beyond Warburg's $6.5 billion return, including the economic productivity enabled by reliable enterprise computing infrastructure. Indian portfolio companies collectively demonstrate Warburg's impact in emerging markets. Companies like Kotak Mahindra Bank, Myntra, Shriram Finance, and dozens of others received early capital and support that enabled them to scale. These companies collectively employed hundreds of thousands, served tens of millions of customers, and helped build India's modern economy. Warburg's willingness to invest in India in the late 90s and early 2000s, when most Western capital avoided the market, provided crucial validation and resources during India's economic transformation. Beyond individual investments, Warburg influenced the private equity industry's development in several ways. First, they pioneered growth equity as a distinct strategy between venture capital and leveraged buyouts. Their approach of providing patient capital to established companies with proven business models became a major segment that dozens of firms now pursue. Second, they demonstrated that private equity could work globally, not just in the United States. Their early expansion into Europe in the 80s and Asia in the 90s showed that the private equity model could be adapted to different markets and regulatory environments, paving the way for the industry's globalization. Third, they showed that sector specialization could generate superior returns. Their concentrated focus on healthcare and technology, building deep expertise, relationships, and capabilities in specific industries proved more successful than generalist investing and influenced many firms to develop sector-focused strategies. Fourth, they maintained institutional quality and stability through multiple leadership generations. Their smooth succession from Pincus to Kay and Landy to Perlman demonstrated that private equity firms could build enduring institutions rather than remaining personality-driven partnerships. Fifth, they generally avoided the ethical scandals and egregious behavior that plagued some private equity firms. While not perfect, they maintained a reputation for fair dealing with management teams, employees, and stakeholders, helping legitimize the industry during periods of public criticism. Every great institution embodies contradictions that can never be fully resolved. For Warburg, several tensions persisted throughout their history. Long-term thinking versus short-term pressures, where they genuinely thought long-term but faced quarterly limited partner reporting, annual fundraising cycles, and market pressures that created short-term incentives. Operational value creation versus financial engineering, where they believed in building businesses through growth and operational improvement but operated in an industry where leverage and financial engineering often drove returns. Patient capital versus deployment pressure, where large funds created pressure to deploy capital that sometimes conflicted with discipline about valuations. Collaboration versus individual accountability, where pooled economics encouraged collaboration but made individual accountability more difficult. Growth versus culture, where scaling from 15 billion to 97 billion in assets under management required adding people, offices, and capabilities but risked diluting culture and decision quality. These tensions couldn't be eliminated as they were inherent in the business model, and success came from managing them thoughtfully rather than resolving them definitively. In 50 years, Warburg will be remembered for several contributions that transcended their financial returns. First, pioneering growth equity as a distinct strategy, demonstrating that patient capital for established companies could generate exceptional returns while creating economic value. Second, globalizing private equity by being among the first major U.S. firms to build substantial capabilities internationally. Third, demonstrating that institutional quality and cultural continuity could be maintained across multiple leadership generations, proving that the industry could build enduring institutions. Fourth, generating exceptional returns for pension funds, endowments, and other institutional investors that supported retirement security and educational missions for millions of people. Fifth, helping build and transform hundreds of companies that created millions of jobs, served hundreds of millions of customers, and contributed to economic development globally. For investors, Warburg's journey raises questions that remain unanswered. Can private equity sustain exceptional returns at trillion-dollar industry scale, or have we reached a point where the industry's own success has made it impossible to generate alpha consistently? If private equity is increasingly index-like in returns as competition intensifies and markets become more efficient, what justifies the high fees and illiquidity? Can growth equity continue working as a distinct strategy, or will it get squeezed between venture capital moving later stage and buyout firms moving earlier? Can any investment firm sustain top quartile performance across multiple decades as it scales to 100 billion or more, or do mathematical and organizational constraints inevitably push large successful firms toward market-like returns? For society, the story raises different questions. Does private equity allocate capital more efficiently than public markets, or does it primarily exploit information asymmetries and regulatory arbitrage? Should we encourage its continued growth or constrain it through regulation? How do we balance private equity's genuine value creation against its potential for wealth extraction through leverage and financial engineering? What obligations do institutional investors wielding hundreds of billions of dollars have beyond generating returns? Should they consider stakeholder interests beyond just limited partners? These questions don't have easy answers, but grappling with them thoughtfully as we assess private equity's role in modern capitalism matters enormously. The Warburg story ultimately teaches that in investing as in life there are no permanent solutions, only intelligent adaptations to continuously changing conditions guided by enduring principles and tempered by hard-won wisdom. Excellence is not a destination but a discipline, a commitment to learning, improving, and maintaining standards even when conditions make it difficult. Warburg's 60-year journey exemplifies this discipline at its best, with all the successes, failures, contradictions, and complexities that make it genuinely instructive for anyone trying to build something of lasting value in a world that never stops changing. As Warburg Pincus looks toward the future, the firm faces a landscape that is simultaneously full of opportunity and fraught with challenges that would have been unimaginable to Eric Warburg when he opened that small office on William Street in 1939, or even to Lionel Pincus when he merged with Warburg in 1966. The private equity industry has matured from a niche cottage industry into a dominant force in global finance with nearly $7 trillion in assets under management worldwide. This maturation brings both advantages and constraints that shape Warburg's strategic choices going forward. The advantages are substantial. Warburg has nearly $100 billion in assets under management, providing enormous firepower to pursue large opportunities. They have offices across North America, Europe, Asia, and Latin America, giving them geographic reach that few competitors can match. They have deep sector expertise in healthcare, technology, financial services, energy, and consumer businesses built over decades of investing. They have relationships with the world's most sophisticated institutional investors who provide patient capital and understand long-term value creation. They have a brand and reputation that attracts quality entrepreneurs and gives them access to proprietary deal flow. But the constraints are equally significant. The sheer size of their funds creates pressure to deploy capital at scale, which can compromise investment discipline during periods when attractive opportunities are scarce. The proliferation of well-capitalized competitors means that almost every attractive deal becomes a competitive auction where multiple firms drive up valuations. The efficiency of information flow in modern markets means that truly proprietary insights or opportunities are increasingly rare. The regulatory and political environment is becoming more challenging as private equity faces scrutiny over its tax treatment, use of leverage, and impact on employment and communities. The elevated valuations across most asset classes mean that even with operational improvements, generating strong returns requires either exceptional execution or favorable market timing. Perhaps most fundamentally, the mathematical reality is that generating 3 to 5 times returns on $15 to $20 billion funds deployed over 3 to 4 years is simply harder than generating similar returns on $1 to $3 billion funds. You need to either do many large deals, increasing the likelihood that some will disappoint, or concentrate in a few massive deals, creating significant concentration risk. Looking at the current market environment, several trends will likely shape Warburg's strategy and results over the next decade. First, the continued growth of emerging markets, particularly in Asia, presents both opportunities and challenges. India, with its population of 1.4 billion, rapidly growing middle class, and improving business environment, remains attractive. China, despite regulatory uncertainties and geopolitical tensions, is too large and dynamic to ignore. Southeast Asia, with its young population and economic dynamism, offers opportunities. But these markets are no longer the uncrowded spaces they were when Warburg entered in the 90s. Dozens of well-capitalized private equity firms now compete for deals in India and China. Local firms have emerged with strong capabilities and relationships. Valuations have risen significantly. The regulatory environment has become more complex and in some cases more restrictive, particularly in China, where government intervention in sectors like technology and education has created uncertainty. Warburg will need to leverage their decades of experience, local teams, and deep relationships to continue generating attractive returns in these markets, but the easy money from being early has largely been made. Second, the technology sector continues to evolve in ways that create both opportunities and disruption. Artificial intelligence and machine learning are transforming industries from healthcare to financial services to manufacturing. Cloud computing continues its relentless march as more workloads move from on-premise to cloud infrastructure. Cybersecurity remains critical as threats multiply and become more sophisticated. Digital transformation accelerates across industries, creating demand for software and services. But the technology sector is also crowded with capital. Venture capital firms have raised enormous funds and are staying invested later into companies' life cycles, competing directly with growth equity firms like Warburg. Public markets through SPACs and traditional IPOs have been willing to value high-growth technology companies at aggressive multiples. Strategic acquirers flush with cash compete aggressively for assets. In this environment, Warburg's challenge is identifying companies with truly differentiated technology, sustainable competitive advantages, and attractive valuations. Their historical success in enterprise software and infrastructure provides playbook and pattern recognition, but they need to continuously update their understanding as technology architectures and business models evolve. Third, healthcare remains one of Warburg's core sectors and the fundamentals remain attractive. Aging populations in developed countries drive demand for medical devices, pharmaceuticals, and healthcare services. Emerging markets are building healthcare infrastructure and expanding access. Innovation in areas like genomics, biologics, digital health, and medical devices continues, creating new treatment options. But healthcare is also facing pressure. Government payers in most countries are focused on cost containment. Drug pricing faces political scrutiny. Regulatory pathways for new products remain lengthy and expensive. Competition from large pharmaceutical companies and well-funded biotechnology firms is intense. Warburg's deep healthcare expertise, accumulated over 50 years of investing, provides advantages in evaluating clinical, regulatory, and commercial risks. Their relationships with physicians, hospital executives, and industry experts give them insights that generalists lack. But even with these advantages, generating exceptional returns requires rigorous selection and disciplined pricing. Fourth, the financial services sector presents interesting opportunities, particularly in emerging markets. As countries develop economically, their financial systems become more sophisticated, creating opportunities in banking, insurance, asset management, payments, and fintech. Warburg has invested successfully in financial services, particularly in India, where they backed companies like Kotak Mahindra Bank and Shriram Finance. But financial services investing requires specialized expertise in regulatory environments, credit risk, and business models that differ significantly across countries. The rise of fintech is disrupting traditional financial services, creating both opportunities in backing innovative companies and risks to traditional financial institutions. Digital payments, online lending, robo-advisors, and blockchain-based services are transforming how financial services are delivered. Fifth, the energy transition from fossil fuels to renewable energy and the broader focus on environmental sustainability creates both opportunities and challenges. Warburg has invested in energy over the years, but the sector is undergoing fundamental transformation. Renewable energy, including solar, wind, and energy storage, is becoming cost competitive with fossil fuels. Electric vehicles are gaining market share. Energy efficiency and grid modernization require massive investment. Carbon capture and other climate technologies are emerging. Institutional investors are increasingly focused on environmental, social, and governance factors, which affects both fundraising and portfolio management. Warburg will need to navigate the tension between traditional energy investments that may face long-term headwinds and renewable energy investments where competition is intense and returns are uncertain. The firm's future success will depend on how effectively they navigate several strategic challenges. First, maintaining investment discipline in an environment where the pressure to deploy capital is intense. With $15 to $20 billion funds that need to be invested over 3 to 4 years, the mathematics create pressure to do deals even when valuations are elevated. Warburg's historical advantage has been their willingness to be patient and hold back capital when opportunities don't meet their criteria. But this discipline becomes harder when limited partners are measuring deployment pace, when competitors are doing deals and generating short-term IRR improvements from deployment, and when deal teams need to show activity to advance their careers. The firm's leadership will need to consistently reinforce that maintaining standards matters more than deployment speed. This requires confidence in their strategy, strong alignment between senior leadership and deal teams, and clear communication with limited partners about why patience serves long-term returns. Second, continuing to generate proprietary deal flow in an increasingly efficient market. The best returns historically came from situations where Warburg was the only investor or one of very few bidders. These proprietary deals had better economics and more favorable terms than competitive auctions. But as information flows have become more efficient and as more firms have built global platforms and sector expertise, truly proprietary deals are rarer. Every quality company that needs capital now typically runs a process that attracts multiple bidders. Warburg's relationships built over decades, their reputation for being supportive partners, and their operational capabilities help them win competitive situations, but often at prices that limit potential returns. To continue generating proprietary opportunities, they need to be creative about sourcing. This might mean partnering earlier with entrepreneurs before companies are fully formed. It might mean finding complex situations that require specialized expertise to underwrite. It might mean focusing on geographies or sectors where they have unique advantages. It might mean building relationships with intermediaries and advisors who can direct opportunities their way. Third, developing differentiated value creation capabilities that justify premium valuations. If every deal is a competitive auction where the highest bidder wins, Warburg needs to demonstrate that they can create more value post-investment than competitors, justifying paying somewhat higher prices. This requires moving beyond generic operational improvement playbooks toward specialized capabilities. Their operating partner network of former executives who can advise portfolio companies is valuable, but many competitors have similar resources. More differentiated might be sector-specific capabilities like regulatory expertise in healthcare, data analytics capabilities that help companies optimize pricing and marketing, international expansion support that leverage their global platform, talent networks that help recruit executives, or technology and digital transformation expertise. Building these capabilities requires investment in people, tools, and processes. It requires figuring out which capabilities create genuine competitive advantages versus which are table stakes that every firm needs. It requires honest assessment of where Warburg has distinctive expertise versus where they should rely on external resources. Fourth, managing the tension between scale and agility. Warburg now has over 200 investment professionals across multiple offices worldwide. This scale provides advantages in terms of deal sourcing, due diligence capabilities, and portfolio support. But it also creates challenges. Decision-making can become slower as more people need to be consulted. Bureaucracy can creep in as processes become more formalized. Communication across offices and time zones requires effort. Maintaining cultural cohesion becomes harder. Junior people may feel disconnected from senior leadership. The risk is that Warburg becomes a large bureaucratic organization that loses the entrepreneurial spirit and decisiveness that characterized its earlier years. Preserving agility at scale requires intentional effort. It means keeping decision-making authority as decentralized as possible while maintaining appropriate oversight. It means avoiding unnecessary process and bureaucracy. It means investing in culture and communication so people feel connected to the firm's mission and values. It means continuing to promote from within and develop talent so people see clear career paths. Fifth, navigating the changing regulatory and political environment. Private equity has faced increasing scrutiny in recent years. Critics argue that the industry uses too much leverage, engages in aggressive tax optimization, extracts value through dividends and fees while loading companies with debt, and sometimes harms employment and communities through cost cutting. While much of this criticism is directed at particular firms and particular practices, the entire industry faces reputational challenges. Regulatory changes could affect private equity's economics and operations. Potential changes to carried interest taxation would reduce after-tax returns for fund managers. Increased scrutiny of leverage and dividend recapitalizations could limit financial engineering opportunities. Greater transparency requirements could force disclosure of portfolio company employment, financial performance, and tax payments. ESG requirements could constrain investment strategies or require additional reporting and monitoring. Warburg's relatively responsible approach to investing, their focus on growth rather than aggressive cost-cutting, their moderate leverage practices, and their long-term orientation position them well relative to more aggressive competitors. But they still operate in an industry facing broader scrutiny. Managing this requires continuing to operate responsibly, being transparent with limited partners and stakeholders about their approach, and engaging constructively with policymakers to help shape regulations rather than just reacting to them. 6th, addressing the growing importance of ESG factors in investing. Institutional investors are increasingly focused on environmental, social, and governance considerations. Some of this is driven by genuine belief that these factors affect long-term value. Some is driven by beneficiary pressure as pension funds and endowments face demands from their stakeholders to invest responsibly. Some is driven by regulatory requirements, particularly in Europe, where ESG disclosure and integration requirements are more advanced. For Warburg, this creates both challenges and opportunities. On the challenge side, ESG considerations add complexity to investment decisions. They need to evaluate not just financial returns but also environmental impact, social effects, and governance quality. They need systems to monitor and report on ESG metrics across their portfolio. They need to engage with portfolio companies on improving ESG performance. All of this requires resources and expertise. On the opportunity side, companies with strong ESG profiles may be more sustainable over the long term. Focusing on businesses that solve environmental or social challenges might tap into powerful secular trends. Demonstrating ESG leadership could help with fundraising from institutional investors who have mandates or preferences for responsible investing. The key is integrating ESG thoughtfully in ways that enhance rather than detract from investment performance while being honest about trade-offs when they exist. As Warburg reflects on 6 decades of investing, several overarching themes emerge about what has driven their success and what threatens their continued excellence. The first theme is that culture and values matter more than strategy or tactics. Warburg's long-term thinking, intellectual honesty, meritocracy, collaboration, and low-ego professionalism have been more important to sustain success than any particular investment strategy. These cultural attributes attracted talented people, enabled them to work together effectively, helped them make better decisions, and allowed the firm to survive transitions and challenges. Maintaining this culture as the firm grows is perhaps their most important task. It requires hiring people who fit culturally, not just those with impressive resumes. It requires promoting people based on values and behavior, not just deal success. It requires senior leaders modeling the culture they want to see. It requires telling stories about the firm's history and heroes that reinforce what the firm stands for. It requires being willing to part ways with people who don't fit even if they are talented. Culture doesn't maintain itself, it requires constant attention and reinforcement. The second theme is that competitive advantages erode over time and need to be continuously renewed. Warburg's advantages in the 70s and 80s were being early to growth equity, having relationships in healthcare and technology, and providing patient capital when competitors focused on quick flips. By the 2000s, these advantages had diminished as competitors copied the growth equity model, built their own sector expertise, and raised large long-duration funds. Warburg's response was building new advantages through early emerging market presence, developing deeper operational capabilities, and leveraging global scale. Now in the 2020s, those advantages are also being competed away. Staying ahead requires continuously identifying new sources of differentiation, whether that's geographic focus, sector specialization, capability development, or business model innovation. Resting on historical advantages leads to mediocrity as competitors catch up. The third theme is that discipline about valuation and leverage matters more than most other factors in determining returns. Warburg's best returns came from investments made when valuations were reasonable or depressed. Their worst results came from highly levered deals done at peak valuations. This pattern repeats across their history and across the broader private equity industry. The uncomfortable implication is that generating strong returns depends heavily on when you invest and how much leverage you use, rather than just picking good companies or adding operational value. This is uncomfortable because it suggests that market timing and financial engineering matter more than skill or judgment. But the evidence is clear. Warburg's 1990s enterprise software investments, their late 90s Indian telecommunications investment, and their 2009 to 2011 investments in various sectors during market dislocations generated exceptional returns primarily because of entry valuation and timing. The fourth theme is that there are inherent tensions in the private equity model that can never be fully resolved. The pressure to deploy capital conflicts with investment discipline. The focus on returns for limited partners conflicts with broader stakeholder interests. The desire for differentiation conflicts with the reality that good practices get copied quickly. Growth in assets under management creates management fee income that benefits the firm but may not benefit fund performance. These tensions are structural, and managing them requires honest acknowledgement and constant vigilance rather than pretending they don't exist. The fifth theme is that private equity's value creation is real but unevenly distributed. At its best, private equity provides patient capital to growing businesses, brings operational expertise and strategic guidance, helps companies expand internationally or develop new products, and creates economic value through business building. Bharti Airtel connecting hundreds of millions to telecommunications, BA Systems enabling enterprise computing infrastructure, and dozens of other portfolio companies created genuine value beyond investor returns. At its worst, private equity loads businesses with excessive debt, extracts value through dividends and fees, and transfers wealth from employees and bondholders to equity investors without creating commensurate value. Bausch and Lomb, where returns came primarily from financial engineering rather than operational improvement, represents this darker side. Most investments fall somewhere in between, with value created through a combination of operational improvement, market growth, multiple expansion, and financial engineering. Being honest about this mixed record, celebrating genuine value creation while acknowledging when returns come primarily from leverage or timing, would serve the industry better than defensive claims that all private equity creates value. The question for Warburg and the broader industry is whether the next several decades can replicate the success of the past 6 decades. The historical context that enabled private equity's growth may not persist. The expansion of institutional investor allocations to private equity from near zero in the 1970s to 5 to 10% or more of portfolios today was a one-time shift that fueled industry growth. Future growth requires either taking share from other asset classes or growing faster than institutional portfolios grow. The inefficiencies in private markets that allowed skilled investors to generate alpha are diminishing as markets become more efficient, information flows faster, and more capital competes for opportunities. The availability of cheap debt that amplified returns during low interest rate periods may not continue if interest rates remain elevated. The relatively benign regulatory environment that allowed private equity to operate with limited oversight is changing as politicians and regulators pay more attention to the industry's practices. None of this means private equity will disappear or become unattractive. Patient capital, operational expertise, and long-term thinking will always have value. Companies will always need growth capital and support. But it may mean that generating exceptional returns becomes harder and that the industry faces a future of decent but not spectacular performance. For Warburg specifically, the path forward requires doubling down on what has made them successful while adapting to changing conditions. This means maintaining the cultural values and institutional quality that have been their foundation. It means continuing to invest in building capabilities and advantages that competitors can easily replicate. It means having the discipline to hold back capital when opportunities don't meet their standards, even when that creates short-term pressure. It means being selective about where they compete, focusing on sectors and geographies where they have genuine advantages rather than trying to do everything. It means thinking creatively about how to source proprietary deals and differentiate their value proposition to entrepreneurs. It means managing the tension between growth and quality, recognizing that bigger is not necessarily better if it compromises investment returns or cultural cohesion. It means being honest with themselves and their limited partners about the challenges they face and what realistic expectations should be for future performance. It means continuing to operate responsibly, considering impacts beyond just financial returns while being transparent about their approach and its limitations. Perhaps most importantly, it means remembering the lessons from their own history. That patience and discipline generate better long-term results than aggressiveness and momentum chasing. That specialization and deep expertise create more durable advantages than generalist breadth. That culture and values matter more than strategy or tactics. That the biggest risks come from success and overconfidence rather than failure and caution. That genuine value creation through business building generates better outcomes than financial engineering and leverage. That adaptation with inconstancy, maintaining core principles while adjusting to changing conditions, is the path to sustained excellence. As we conclude this deep dive into Warburg Pincus, what becomes clear is that their story is ultimately a very human one. It begins with Erich Warburg, a refugee fleeing Nazi persecution, who arrived in New York with little but his family name and determination to rebuild. It continues with Lionel Pincus, the ambitious son of immigrants who saw an opportunity to create something new in American finance. It includes hundreds of professionals who joined the firm over 6 decades, contributed their talents and energy, and built something larger than themselves. It encompasses the entrepreneurs like Sunil Bharti Mittal and the BA Systems founders who partnered with Warburg to build businesses that created enormous value. It touches millions of employees at portfolio companies, customers who used products and services those companies provided, and beneficiaries of pension funds and endowments who received returns from Warburg's investments. Behind the dollars and deals and returns are people making decisions, taking risks, working to build businesses, and trying to create value in a complex and uncertain world. The Warburg Pincus story reminds us that finance at its best is about more than just making money. It's about allocating capital efficiently to where it can be most productive. It's about supporting entrepreneurs and management teams who are building businesses that create jobs and serve customers. It's about providing patient long-term capital in a world that often focuses obsessively on the short term. It's about building institutions with cultures and values that endure across generations. These contributions are real and valuable even if they come mixed with the less admirable aspects of an industry that sometimes prioritizes returns over broader stakeholder interests. What we can take away from 6 decades of Warburg Pincus is that excellence in any complex endeavor requires multiple ingredients that must be sustained over long periods. It requires talented people who are smart, hardworking, and humble enough to keep learning. It requires culture and values that guide behavior when decisions are difficult. It requires discipline to maintain standards when pressures push toward compromise. It requires adaptation and evolution as conditions change. It requires patience to let value compound over time. It requires honest self-assessment to learn from both successes and failures. Most fundamentally, it requires recognizing that there are no permanent advantages, no guaranteed formulas, and no substitutes for consistently doing the work of finding opportunities, conducting rigorous research, making sound judgments, supporting portfolio companies, and maintaining the discipline and culture that enable sustained performance. Warburg Pincus has done this better than most for nearly 60 years. Whether they can continue for 60 more in an increasingly competitive and challenging environment remains to be seen. But their track record has earned them the benefit of the doubt, and their story provides lessons that extend far beyond private equity to anyone trying to build something of lasting value in a world that never stops changing.